Hey everyone, and welcome. Today, we're tackling a question that every single investor asks. How am I really doing? We're going to go way past those simple, shiny numbers and actually build a toolkit that lets you properly measure your investment performance. So let's get right into it.
So picture this. You open your statement and you see you're up 10% for the year. I mean, that feels pretty good, doesn't it? But is it actually good? Is that the whole story? Well, as we're about to find out, that one simple number can hide a whole lot.
At the end of the day, this is what we all really want to know. Is our money just sitting there, or is it truly working for us? The big difference between just being a saver and being an investor is learning to ask the right questions. And today, we're going to learn exactly what those questions are.
Yeah, to get a real, honest picture of your portfolio's health, you need so much more than just a single percentage point. We need better tools. So think of this explainer as us building your own personal performance analysis toolkit, one essential piece at a time.
Okay, our very first tool is the foundation for everything else. It's called the holding period return, or HPR for short. It's really the most basic, straightforward way to see what you got back from an investment.
The name really says it all, right? It's the total return. That means capital gains, dividends, interest, the whole shebang that you earned during the exact time you owned an asset. It's a simple, what did I get back versus what did I put in kind of calculation.
And the calculation is beautifully simple. First, you just take your ending value and subtract what you started with. Then, and this part is absolutely key, you add in any income you got, like dividends. Finally, you take that total number and divide it by your initial investment. That's it.
So let's run through a quick example. Let's say you invest $10,000, and later on you sell for $11,000. No dividends, nothing else. That's a $1,000 gain divided by the original $10,000, and that gives you a nice, clean 10% holding period return. Simple. But now, check out how much income can completely change the picture. Imagine you invested that same $10,000, but this time you sold for $20,000. Okay, that's a $10,000 gain. But you also got $3,000 in dividends along the way. Your total gain is now $13,000, which gives you an incredible 130% HPR. See? This is why you can never, ever ignore the income part.
So HPR is a fantastic start, but it's missing something huge. A 130% return sounds amazing, right? But what if you had to risk losing every single penny to get it? HPR doesn't tell you anything about the roller coaster ride or the sleepless nights you might have had. It tells you what you made, but it says nothing about the price you paid in risk.
And this right here brings us to the most critical upgrade for any investor's toolkit. To really truly understand performance, you have to measure your return against the risk you took to get it. Without that context, a return number is almost meaningless.
And for this job, we have two fantastic tools, the Sharpe Ratio and the Treynor Ratio. The Sharpe Ratio measures your return against the total risk, all the ups and downs of your investment. The Treynor Ratio, on the other hand, measures your return against just the market risk, how much your investment tends to move with the overall market. They both help answer that same crucial question. Am I getting paid enough for the amount of risk I'm taking on? This table just breaks it down perfectly. The Sharpe Ratio uses standard deviation, which is basically a measure of how spread out your returns are, to figure out total risk. This makes it perfect for looking at your entire, diversified portfolio as a whole. The Treynor Ratio uses beta, which measures how volatile your investment is compared to the market, to calculate just the market risk. This is way better for looking at a single stock or a single fund within your bigger portfolio.
And here's a fantastic little trick to remember the difference. Just think, Sharpe was the smart guy who used the harder concept, standard deviation, which, let's be honest, a lot of students find more complex than beta. It's a simple little memory aid to keep them straight.
So we have our return, and we've adjusted it for risk. We're almost there, but there's just one more layer of context we absolutely need. How did we do compared to, well, everyone else? This is where benchmarking comes in. Now, you can't just pick any old index and call it a day. A good benchmark is like a good ruler. It has to be the right one for the job. It needs to match your investment style. You have to be able to actually invest in it. It can't be ambiguous. And this is a big one. It has to be specified before you start measuring. Otherwise, you're just drawing the finish line after you've already won the race.
And the ultimate measure of how you did against the benchmark is called alpha. Alpha is that extra return your fund manager generated above and beyond what the benchmark itself delivered. It's their value add. But, and you have to remember this, alpha can also be negative. That means their decisions actually cost you money compared to just buying the index.
It's really simple to see in practice.
If the market benchmark, let's say it's the S&P 500, returned 8%, but your portfolio got you 11%, that 3% difference right there, that is your positive alpha. That's the skill that you're paying for.
Okay, so we've covered return, we've covered risk, and we've covered benchmarks. But there is one final, really sneaky trap we need to watch out for. It's a cognitive bias that can make average returns look a whole lot better than they actually are.
It's called survivorship bias. See, when you look at the average return for a group of funds, that data often only includes the funds that are still around today. It conveniently leaves out all the funds that performed so badly they had to shut down and disappear.
I absolutely love this analogy because it just makes the concept click. It is exactly like calculating a class's average GPA, but you only include the students who didn't fail and drop out. Of course the average is going to look amazing. You've literally removed all the worst performers from the list.
And this chart just shows you the real-world impact. The true average return of all the funds that started out might have been, say, 6%, but once you remove all the failures, the survivors-only average suddenly jumps up to 9%. That is a massive distortion, and if you're not aware of it, you can make some really bad decisions based on faulty data.
So here's the crucial point. Let's tie it all together. A real performance evaluation isn't just one number. It's a four-part framework. You need your holding period return. You need your risk-adjusted return using Sharpe or Treynor. You need to check your performance against a fair benchmark using alpha. And you need to keep an eye out for those hidden traps like survivorship bias.
Now you have the toolkit. So the next time you sit down with your investment statement, you'll know exactly what to look for and what questions to ask. You're not just a saver anymore. You're an informed investor. So the only question left is, which of these new tools are you going to use first?